So good afternoon. Welcome to our webinar. You can see there by the title, how is economic growth reflected in the share market performance? I know it sounds like a silly question and also seems logical, but when the South African economy is growing or expanding, more people are buying goods and services and more likely to invest. And obviously this provides support to the share prices on the JSE. Saying that, obviously conversely, when the economy is struggling, people tend to avoid spending, and companies and their share prices obviously take a knock and they see a decline. So a share price, and this is important, a share price factors in what investors think a company will earn in the future. That's called discounting, and we'll touch on it a bit later just now. So if investors are confident, and it's also very important to understand that confidence is a very important thing. It drives market sentiment. If investors are confident in the likelihood of economic recovery, obviously share prices will likely rise. As I say, it all seems very logical. Now the challenge comes in, anytime you put money, your own money, at risk to profit, there's an inherent level of uncertainty. And this uncertainty, another way of looking at it, is what we call market volatility. So when new threats such as war or recession arise, the level of uncertainty increases significantly, as companies can no longer actually predict their future earnings. And this obviously makes it muddy waters. So as a result, institutional investors, the big boys, they will reduce their holdings in shares considered unsafe, and we'll touch on that again a bit later, and move into funds that, or to other asset classes like precious metals and government bonds and money market, etc. So obviously this sell-off, when it does occur, and this is also important to understand, when it occurs in large portfolios and they obviously reposition themselves, this can cause obviously the market to depreciate. So these situations, obviously, this heightened uncertainty or this volatility arises. Your best defense is to be well informed as possible. And that's the crux of this presentation today, to be well informed, to educate yourself. Okay, so this leads to great opportunities for investors who position themselves to take advantage of it. Okay, so here's the agenda today. If I can just move this out of the way quickly. Here's a quick agenda. And my whole goal today is to help you how to position your investment portfolios in times of uncertainty like we're seeing right now. So to answer a question, does the share market reflect the economy? Another way we're looking at it is, what's the relationship between the country's economy and the stock market? Is there a relationship? Is it always true that the stock market reflects the country's economic conditions? And the answer is yes. The stock market will reflect economic conditions of the economy. But saying that, obviously the fluctuations in the share prices on the stock market can sometimes seem to be inconsistent. And when this is happening in the real economy, there's that disconnect, and this is what we're going to talk about today. So that the real economy disconnect. So I'll be talking about three things, or touching on three things. I don't know, highlight the definition. We talk about recession, we talk about a correction, and we talk about a bear market. A recession basically is when the economy goes into two, well, the economy starts falling, and the GDP, or the growth factor, or the GDP growth goes into negative. So we have two negative quarters of negative growth. That's the definition of recession, and I don't think we're there yet. A correction, a market correction, when the market pulls back 10%, and that's average, that's normal. Bear market, when we pull back more than 20%. Okay. So there's also a big difference between what we call a recession, which lasts a few months, okay, and a depression, which can last a few years. I also don't think we're there yet, okay, or not there. So just to illustrate for you, I think this is a chart of the S&P 500, which is the top 500 companies in America. And just this week alone, it was quite interesting that it has pulled back into what we call bear territory. You can see it's touching very important support levels. Number one, so what is it's obviously it's since this is way back. Let me bring back my cursor here. that was the whole COVID thing where we went into a hard lockdown. This is worldwide. Okay, that market, that was a 32% drop. Okay, you can see it took a market quite a few, just a few months, 6 to 7 months to recover. And from there to this has been, I think it was roughly about a 20, more than 20%. I can't remember offhand what it was. 26% growth from those highs there. Okay. Incidentally, from there, from that low to here, it was 114%. But as I say, the market has since then pulled back 20%. So a lot of people are talking about a bear market. So, it's interesting, as I say, bear market is more than 20% from its highs. And they call this, they don't like to use the word bear market anymore. They talk about a healthy correction. And this is a healthy correction. But saying that also, you can see this is what they call an MACD indicator. You can see last time we were seriously oversold. There was more sellers than buyers pushing the price down. This is what we call oversold. And we're very close to that right now. So you can say to you, you're in the bear market or a healthy correction, or you can say, wow, look at the opportunities we have right now, because we are pretty oversold. This is obviously talking about the American markets. And to a large extent, obviously, the JSE is in the same boat. Okay, so let's talk about that question again. Does the economy, the share market reflect the economy? And as I said, yes, it does. So it does, to a certain extent, what we call anticipate what's happening in the economy, and we'll touch on the economy a bit later. But all it is, the main factor that drives share market price or share prices is investor demand. So obviously, where there's more buyers than sellers, the buyers push the price up, and where there's more sellers that push the price down. But there's 4 factors, and these are the 4 factors there that will be highlighted in demand. And obviously, also when these factors fall, the market falls. So we're talking about the economy, we talk about earnings, we talk about expectations and emotion. You can refer to them as the 4 E's. So first of all, obviously the economy. There are a lot of factors that drive stock market prices. Obviously, interest rates and unemployment and currency fluctuations. As I say, more on that a bit later. But I want to touch on earnings. So JSE listed or public traded companies typically report earnings twice a year. They call the interims, the first 6 months, and then the finals, which is for the whole year. But investors will publish any company or any the shares of companies that cannot meet their expectations or their projections, or the consensus estimates from the obviously research analysts. And we saw this week, for example, Richmond results were the market did not like it, and obviously it missed on a lot of things, and the share price was knocked down big time. Okay, so share prices generally rise when companies meet or exceed published estimates. And obviously those companies also, as I say, provide what they call optimistic guidance about upcoming earnings results. Is when they don't, and when the analysts take it and it's worse than expected, then you'll find that the share market takes a harsh look at those shares. As I say, Richmond was a classic example this week. What's more important also is those expectations. So as I say, where the market anticipates those results. So the market, the stock market, or the market players as such, look ahead. They tend to look ahead 6 months and more, up to a year in advance. So in other words, we anticipate future events, and we're discounted. That's a very important word to understand. Discounted into today's prices. Okay. So when it comes to the market and things like that, you find that share prices usually reflect those expectations about everything from companies' revenues and profits to even obviously things like election results, election outcomes, etc. So as I say, companies would usually provide those guidance. We have what we call trading updates here in South Africa. If the company anticipates their earnings to be more than 20% compared to the previous reporting period, they have to tell us that through a trading statement, and that's what they call sense announcement. So keep an eye on those kind of things. So expectations are very important, and the market anticipates those things all the time. And then also very importantly, emotion. That's the 4th E here. We talk about basic human emotions such as greed and fear that also affects the market. And right now, and I can see there's lots of knee-jerk reactions from from the small private investor. There's some panic selling, obviously pushing the price lower. And, the clever money or the experienced investors ignore these periods of market tantrums. You can call it a market tantrum because they know that the underlying business fundamentals are going to determine the long-term price trends. So when I say the experienced investors, I also call this the clever money. So there's a lot of opportunities on the market now, and there's a lot of opportunities you can take up right now. And as I say, be on the side of the clever money. So the 5 economic factors that influence share prices. So there's a lot of things happening, obviously, in the world right now, and markets seem have been very volatile. We all know that. But it's also good to take a step back and look at the big picture. And I think that'll be useful. And that's, as I say, there are a lot of economic factors we can look at. I just want to highlight 5. So first of all, GDP. We're talking about GDP growth. And I'll touch on that on the next slide. But basically, politicians often talk about economic growth, and it's a connection to job creation. But what does economic growth actually mean? So economic growth occurs when the country's production capacity increases. Here in South Africa, you can say it's the health of the country's economy. And there's a lot of diverse opinions on that too. So bottom line is investors would use the GDP to make investment decisions. A bad economy often means lower earnings and share prices. Our economy, our share market is really much skewed to more the global stocks, the companies that are rand hedged, that are offshore. So sometimes that picture does get skewed a bit. So when we talk about GDP, this is a quick slide I got from Stats South Africa, and it just highlights for you obviously what's happening in the economy. This is just quarter on quarter. This is what they call real GDP, taking out the effects of inflation. But obviously many companies are being hit by supply chain issues. The global shortage of semiconductors, the war in Ukraine, obviously triggering fuel price hikes, obviously high inflation and slow economic growth. So you can see here, this is, as I say, the slide what they call the real gross domestic product. This is obviously measuring production. It's only increased 1.2%. That was the last quarter of 2021. This is following the decrease of negative 1.7 in the third quarter. So considering the full year of 2021, the South African economy expanded by 4.9%. Okay. This is all from Stats South Africa. That's the most in 14 years, which is quite surprising. And this again, that disconnect between the stock market and the economy. And this is recovering obviously from the 6.4% pandemic-induced decline in 2020. So saying that also, the country's real GDP growth is expected to average 2.1% this year, 2022, and they anticipate or expect this to grow on average about 1.8% over the next 3-year period. Yeah, we'll see if that happens. Okay. So that leads on to the next one, obviously oil prices. The oil price appears to have stabilized somewhat. Sorry if I say oil price. The oil price appears to have stabilized somewhat after surging. This is in the wake of Russia's invasion of Ukraine back in February. Russia is a major oil producer, and the oil market obviously reflects anxiety over supply constraints. Already, there are many Western companies that refuse to buy or sell Russian oil, while governments in Europe are considering an outright ban on Russian oil. So now you can say that oil is a tax, acts like a tax. We need to move around it in the absence of alternatives, and just obviously cough up for a higher oil price. There's talk about the petrol price going up for $3.50 a litre next week Wednesday. So you can imagine the consumers have less money, disposable money in their pockets. So yes, it is a drag, and this is what's important to understand also. If it gets to beyond a certain unknown point, obviously will be a drag on people's purchasing power. to be too great. People say, geez, it'll be too expensive to work, to go to the office anymore. Maybe more people start working from home again. But also say that, companies will start closing, jobs will be lost, and obviously, and we'll need the oil price or petrol price to come down. So this is what they call demand destruction. So, and again, you might want to say to yourself, yeah, how can I take advantage of this, the oil price? Maybe to have Sasol in your share portfolio to a certain extent. It is a rand hedge, and obviously it was also a play on the oil price. Another way of looking at it, you can also have exposure to, I think there's a Standard Bank as a ETN, oil ETN, that you can also have exposure to the oil price. So something to consider. So here's inflation rates. This is South African CPI. You can see April compared to the previous year, 5.9. Remember, the Reserve Bank has got this mandate to keep inflation between 3 and 6%. We're very near the top of that cycle. Okay. Obviously, the biggest influence was obviously petrol. It's our biggest import, oil rather. So yeah. Why is it important to look at inflation from an investor's point of view? Understanding inflation is crucial to investing because inflation can reduce your value of your investment returns. It's all very well making 5 or 6% returns, but inflation is at 6%. You're basically you're net. You're breaking even. So you need to outperform that by far, and that's why it's important to have a view on that. So, inflation is what they call public enemy number one. You need to have a very good idea of what's happening with inflation. And again, there's a few definitions. Stagflation. That's what they're also worried about now is persistent high inflation that we've tackled with high unemployment and stagnant demand. That's the one side of the coin. The other side of the coin is when prices start falling, we have a reduction in the level of prices. This is what they call deflation, and central banks are very worried about that because obviously the main thing is no one spends money because everybody's waiting for better prices on goods, and obviously there's lower demand and lower profits, etc. So there's various ways to look at it, and this is coming back to what I said just now about educating yourself. Be aware of these kind of things. So is it good to invest during times of inflation? It's more important than ever. So why? Because investing in shares, especially shares, is generally a good way to outrun inflation. In other words, growth is always a bit higher in shares compared to putting your money in the banks and earning that kind of return. Okay, so it leads me on to the next one. How does the Reserve Bank handle inflation? They use it with interest rates. We saw that the repo rate increased by 50 basis points or 0.5% I think it was last week. And you can see the relationship between the repo and prime interest rates, very much the same thing. But we've had this period where we have lower interest rates, where we've bottomed out for a long time, but now we're seeing the trend changing. I'm putting a slide up here just to highlight for you the relationship. Always think of the relationship between interest rates in the stock markets like seesaw. When interest rates go up, market comes down. When interest rates go down, the stock market goes up. So it's like a seesaw. I think that's the easiest way to look at it. So obviously worldwide, central banks control short-term interest rates, usually with overnight funding. This is what they call the repo rate for the banks. This is the repurchases between the banks. But the market determines a wider range of longer-term interest rates. But they all reference, obviously, the central bank's policy rate. So in developed markets, bond yields have moved up sharply, discounting a number of central bank future hikes. And this is one of the problems when it comes to their uncertainty. They're anticipating more interest rate hikes. What's also interesting to note is the aggressiveness. How much are they going to raise interest rates by? 25 basis points, 0.25%, or 0.5%, 50 basis points, or very aggressively 0.75% or 75 basis points. So there's a lot of speculation about it and where would interest rates be by the end of the year. Just understand, if we're anticipating much higher interest rates by the end of the year, that'll be discounting the share prices right now. Okay, So why is it important for investors to understand what's happening with interest rates? Because obviously interest rates affects the cost of borrowing, the return on savings and things like that. So we have a switch of funds out of the stock market, and we have what we talk chasing yield. So that's also things to understand. Okay. Industrial shares, consumer names, and retailers usually outperform when the economy improves and interest rates move higher. But also there are some sectors such as real estate that cools down during interest rate hikes, and more on that a bit later. So the last one I want to talk about is exchange rate. The exchange rate, or let's talk about the rand to the dollar. The rand has been its usual volatile self this year. It was initially a strengthening as commodity prices, especially coal, one of our major exports jumped more than oil. Obviously, for them to take advantage of that, they had to come and buy rand to buy into the coal, and obviously that created a demand for the rand, and the rand strengthened. You can see my graph here, when the trend comes down, that's a strong rand. When it breaks up, we can see recently we've had a very weak rand, and since then the market has pulled back. You can see on my MACD indicator again. It's been, and this will be the opposite. You can see my resistance lines are blue, and vice versa. So we've hit support. We've gone up through all these resistance lines, but now you can see this is oversold, and now we're pulling back to overbought territory. So when the rand's back in these levels here, this is when you want to consider going into offshore stocks or take your money offshore, when the rand is strong. Okay. So yeah, it's just basically the rand, very much like the economy, or like a share price to economy, shows people's perception or sentiment towards towards economy. Okay, so the dollar has been very strong, and there's two reasons for that. Number one, obviously, when it's elevated risk aversion, people flock to the safety of the dollar. That's number one. And number two, obviously, US short-term interest rates are expected to rise faster than those that in Europe. And as I said just now, this is obviously offering investors a higher yield, and people are chasing yield. Okay. Interesting times we live in. So talking about that, the 5 factors show a picture that complex of a complex world that's still recovering from the pandemic, but is also now dealing with new threats. We see what's happening in China with renewed Chinese lockdowns. The Russian war is obviously still continuing and still creating a lot of uncertainty. But also we're seeing now, obviously, many central banks are tightening their policy all at the same time. So this is leading, as I said just now, this volatile nature of the equity market is very evident. Declines of more than 10%, as I say, are common and typically do not last long. But saying that, also declines in excess of 20% can take a bit longer, and they coincide usually with a recession. And I'm not saying we're going into a recession, but the market could, at this point in time, be anticipating and discounting a recession. So, a lot of this bad news is already priced into the equities. So when I say the bad news is already priced in, that's the good news. The market has pulled back already, so now all we have to go do some homework now and find companies that will benefit or do well in a recession. So this year is always going to be a tough year for investors. We've had 2 years of returns. You saw just now on the S&P 500 how the market has flown from those lows of March 2020. The market went up more than 100%. Since then the market has pulled back. So investors could be flocking into fixed income investments such as bonds or dividend yielding investments during times of recession. But also, saying that, it's also it might be frightening times. It doesn't have to be unnerving. Just have to know what you're going to look for. And this is what I want to highlight here for you. So the five things that you want to invest in when the economy declines or recession hits. Number one is your goals, your personal goals. In other words, investing in yourself. You know, you have to ask yourself these kind of questions. You know, what are you looking for? Are you looking at minimizing the risk from investments? You know, and that's what's important, is to have a diversified share portfolio. You want to have between 3 and 5 different sectors, or exposure to 3 to 5 different sectors. You want to have all your money in gold, for example, or IT stocks or financials. You want to have 3 to 5 different sectors and between 8 and 12 different shares. So that's one way to minimize your risk. Secondly, you know, do you want to maximize your long-term returns? You know, are you positioned more for growth, more for value? Are you taking profits now? All those kind of questions you need to take now. I believe that if you're taking profits now, you must understand that obviously there's CGT and those kind of things too. Or you want to create more fixed income? Or are you focusing more on dividend companies? And then lastly, obviously, you know, are you investing in the stock market while prices are low? In other words, are you buying into the dip? Are you buying some, you know, you say, are you a bargain hunter at these levels? So it all comes down to quality. I believe there's a lot of opportunities in the market right now, especially you want to be focused on quality companies. So that's number one, invest in yourself, okay? Invest in your, in getting to know more about the market. But also, when I say invest in yourself, the second thing I want to highlight for yourself is just to fine-tune your investment philosophy. And I want to highlight, this is what they call the 3M investment philosophy, and this is from PSG Asset Management. The 3Ms refer to the margin of safety, and that's very much around the price, and then also talking about the moat and management. But you can go onto the website and get more information about that. But develop your own kind of investment philosophy. What do you want to focus on ultimately? I like this as a foundation for my investment portfolio. You know, margin of safety, looking at the quality of the company, and the quality, you know, you can look at things like you know, the current share price relative to its intrinsic value, what's the real value of the company. So I believe right now the market is having a sale, and you want to get excited when the market is having a sale, especially with quality companies. Okay, so just wanted to throw that in there. That's the second point. The third point, where do you want to invest, is there are certain sectors that perform well when the market goes into a recession. So companies that sell their shares in the stock market are obviously broken into different sectors. Sectors or groupings that pertain to the type of businesses that the companies engage in. Now, during a recession, some sectors of the economy, as I said, perform better, outperform others, as consumers shift their spending, as their consumers' needs shift. So, you know, both the healthcare and the consumer staple sectors are examples of that. Now, you can say to yourself, you know, and this is, you can say PSG's house view, we like financials and healthcare and consumer staples, and I'll touch on those now a bit more. But what kind of company would you like to get invested into? Shares that do well during recessions. Basically, you know, it might be very tempting, and this is what some small private investors do. They switch out of the market completely and go sit in cash. So it's very tempting to ride out of a recession with no exposure to the share market. But the problem is you're missing out on opportunities. It goes back to that old saying, it's not timing the market, it's time in the market, what's important. So historically, there are companies that do well during economic downturns, and this is what I want to focus on. So investors might consider developing a strategy that's more based on counter-cyclical stocks with strong balance sheets and obviously recession-resistant industries. So that's number one. So what I mean by companies with strong balance sheets, you know, a good investment strategy is buying into companies that have a strong balance sheet, or company that has a steady business model despite what's happening in the economy. It can be a boom or a bust. So these companies are less vulnerable to tightening credit conditions or rising interest rates, and obviously they have a much easier time managing the debt they do have, if they do have any debt. So usually these are companies that, and the best place to look for this is get hold of the company's financial results or financial statements, and you can look for companies that have low debt, healthy cash flows, and obviously generating a profit. Okay, so that's number one. And number two, obviously buying into companies that are dividends, and this is a good indication for me. If you're going to hold shares during a recessionary period, the best ones to own, as I mentioned just now, companies that are well established, blue chip shares, okay, well established, been around for a long time, large caps, as I say, blue chip shares with strong balance sheets and cash flows, okay. They can weather a downturn. They've been around for a long time, but also they're more likely to pay out dividends. And dividends are two things. It helps two ways. Number one, obviously, you have a peace of mind that you're buying into a company that's stable, been around for a long time. And obviously, dividends also provide that extra return cushion as such. Okay. And then let's talk about recession-resistant industries or defensive companies. And this is where we talk about consumer staples. So, you know, during recessions, consumers need to buy food. They still buy into the drugs. They still, when I say drugs, obviously healthcare drugs, hygiene products, and medical supplies. So these are what they call the consumer staples, and you'll see on the next slide some examples of that. So these are the last things that a family would cut out of their budget because they need food. We need healthcare. Okay, so companies that are as we can call them defensive stocks. These are the ones you want to be in right now. Okay, they remain resilient when the economy starts fluctuating. So when you log into your account on PHG's website, PHG Online, you go click on that little tab called Viewpoint. One of the options you have there is to look at a watch list. Now, you can type in this little box here where it's watch list, you can type in the word consumer staples. It'll bring up the list of those shares, the sector, and those companies. And you can see the names in these shares here. It'll be the AVR food company. You can see here Tiger Brands food company. You can see the companies that sell food products. It'll be the Pick and Pays and the ShopRites and the Spars. Okay, but you can also see companies like Clicks, the healthcare products, and Dischem are in that list. Okay, so that's quite interesting. Then you also got things like Oceana food, fish. You got things like African Rainbow Limited, chicken. Okay, so these are consumer staples. These are the kind of companies that you want to maybe look at adding in your portfolio that are, as I say, resilient to a recession. Okay, so you can see the share code there. And also, I suggest you can click this little button over there. You can rearrange these little columns. I like to put the PE ratio right near the front. You can see some of these companies are not cheap from a PE ratio. The market is about 12. You can see some of these companies are trading on a 28 and a 24. But as I say, these are the companies that you want to have in your portfolio right now. So consumer staples include, as I say, food and beverages, household and personal products, even alcohol and tobacco. The Anschauer Bosch, the old breweries, SA breweries, there's number one. You can also see BTI, tobacco. So even times of when people are still depressed and things like that, they turn to alcohol and tobacco. Okay, even to gambling. Okay, you can see as say not tobacco, not gambling, but it's alcohol and tobacco. Okay. So the next one, obviously, is our healthcare. You can type again, healthcare, health, and then space care. You'll come up with the Adcock Ingrams of the world and Aspen Pharmaceuticals. Those are our two pharmaceutical companies. And then you can see our medical companies. You've got your Life Healthcare, Hospital Group, Mediclinic, and Netcare. Okay. So those are also defensive companies that you want to maybe want to have in your portfolio. Okay. By the way, tomorrow, not tomorrow, Friday 27th, we have a webinar, 9 o'clock in the morning, where we'll be discussing the US pharma companies, the Pfizer's and the Johnson & Johnson, and there's quite a few other companies. And we have our analysts and our traders be talking about the markets. So, yeah, you're welcome to come join us. You should have got an email from us. If you haven't, drop me an email. You're welcome to join that. It's Friday morning, 9 o'clock. Okay, but that's another way of having exposure to recession-proof or defensive companies is the healthcare sector. And then what do you want to avoid in a recession? Obviously, the companies that come to mind is companies that are very highly leveraged, companies that are cyclical, and companies that are very speculative. When I say speculative, they're risky. Okay, you want to avoid those companies. So obviously, highly leveraged companies, these are companies that have a lot of debt on their books, and obviously, as we have higher interest rates, we have these guys being more exposed. They'll be paying more of their revenue or their profits towards paying down the debt and things like that. And you'll see these companies have a very high debt equity ratio. Avoid those companies. So they've got a more highly likelihood of bankruptcy and those kind of things. Okay, but they're not obviously not won't be shareholder friendly. Cyclical stocks, these companies usually go in the same direction as the economy. So they usually tied to employment and consumer confidence in that. So you find that when the market turns around, these companies get clapped also. So they do well in boom times, but not so well in obviously when the market is coming off. So these are the consumer discretionary companies. This is when you got a lot of money in your pocket and you can send your children to private schools and things like that. Okay, when you want to do home renovations and you go to cash build and you want to go out, you got money on your extra money in your pocket. Let's go out and get takeaways, or let's go to famous brand, to one of our Wimpies, or famous to our mug and beans. You know, when money's tight, you don't do that. You know, you don't go to Sun International. You don't go to spend money on things like clothing and things like that. That's what we call discretionary, consumer discretionary. So there's a list of companies that you want to avoid in times like this. Okay, so I hope that also helps you guys. So before we knock any questions, you know, while this environment might not be unique, the volatility on the share market is not. We've been here before. You know, recessions and volatile markets can be frightening times, but if you're investing in for the long term, number one, you have a long term view. What's important is to keep a even kill. You know, is to be objective. You know, be aware of the emotions, the greed and the fear, but as I say, be objective. In many cases, the best thing to do is nothing. You know, to trust the market's resilience, and obviously diversification is what you built into your portfolio. What's going to save you? Okay. So as I say, keep it even keel. Avoid making knee-jerk changes to your portfolio. What's important is to have it, as I say, that investment strategy that's properly diversified. But also, I believe if you've got a very well diversified portfolio, be patient. You know, there'll be enough other opportunities where the valuations in the market will be presenting opportunities for you. And this is what you want to tackle. Okay, so let me see what kind of questions you have. I have gone over time. So let me see what questions you guys have here. There's a question from Sheffel. What unit trust fund would I recommend? Sheffel. Obviously, I'll be a bit biased, and I don't want to give investment advice here, but you know, maybe consider looking at the PSG funds. I touched on their free investment philosophy, but also just the PSG funds on our platform offer you lower admin fees, so that's a big plus. As I say, I like that 3M investment philosophy of marginal safety, moat, and management. Go look at the fund fact sheets, you know, and understand what the philosophy is, and that might resonate with you, and that's what you want to buy into. You know, I like the PSG balance funds, but also you can look at the global funds. They have that spread. There's a question here from Arun. With all of Tiger Brand's problems, would you recommend purchases for the wide range of consumer products? Yeah, Tiger Brands and Anglo-Vol Industries, AVI, have very much the same PE ratio, they're very much the same. You have to see which one's bigger. It's a toss-up between the two of them, Arun. They're very much on the same dividend yield. I think last they were about 5% dividend yield in both. But I'll have to dig a bit deeper. They've had a lot of problems. I remember being a shareholder of Tiger Brands when they had the whole bread collusion story. And it's amazing that the shareholders took the knock, but not the directors. Question from Vessel. Will a proper diversified strategy not just result in only an all share type of return? I'm not 100% sure what you mean by that. All share type return. If you're stock picking Vessel and you're buying into good quality stocks, I'm talking about when the market recovers or the economy recovers. What's alternatives? Where are you going to put your money? Are you going to put your money in the banks? So I'm not 100% sure of your question there, Vessel. Okay. There's another question here from Sally. Is it too late to sell now? Ish, Sally. It's a difficult one. Obviously I have to look at your portfolio and things like that. But I always come back to the thing is, what was your original decision? Were you an investor? In other words, a buy and hold long-term investor, or were you a trader, buy and sell? That's number one. Secondly, what's important, has anything changed? Has anything fundamentally changed with the companies in your portfolio? And most of the time it's not. Nothing has really fundamentally changed. So yeah, those are the kind of things you have to look at. Again, it comes back to the question, if you have a diversified portfolio, you have exposure between 3 and 5 different sectors and 8 to 12 different shares. What you lose in the swings, you make up in the roundabouts, But the wrong thing to do right now, to answer your question, Sally, is to have that knee-jerk reaction and sell, where it's panic selling. Your emotions are driving your decisions, and that's the wrong thing to be doing right now. Okay. I hope that answers all your questions. That looks like everything. Yeah, that looks like all of it. Barbara, buy more Sasol. If you haven't got exposure to Sasol, maybe consider buying it now. Over the years, I've realized that Sasol is more a rand play than an oil price play. So when the rand weakens, I find these guys, the share price jumps up faster. But it's good to have exposure to call it any rand hedge, and Sasol is one of the better ones. I like Sasol. I've always been married to Sasol. Mohammed, again, resource stocks right now are very cheap. If I look at some of the PE ratios on some of those companies, I like them. But again, you have to say, if China is in hard lockdown, and that's where a lot of our demand comes through for our resources, things are maybe changing there slightly with the results from the COVID. So things might open up. I like to have maybe exposure to what do you call the Resi, the Satrix Resi. That's just through one share having exposure to 10 stocks. That's one way of looking at it. But there's a lot of opportunities there. A lot of those, as I say, resource stocks are, the PE ratios are very, very low multiples, and they're still paying a very attractive dividend yields. So yeah, maybe have some exposure to that. I like that. And that also goes back to that question, having a diversified portfolio. Guys, I'm running out of time, but thanks for all your questions. Just to quickly summarize, get us out of the way. So in conclusion, wrong way. I believe if you're a novice in the market, it's very important that you educate and keep informed right now. Even if you're a bit more experienced, is to have your finger on the pulse what's happening. One way is to keep yourself informed is to join the PSG Wealth Dealing Desk Telegram group. Now, this is only for existing clients, especially clients with an equity trading account with PSG, the Telegram number. And the reason why we're using Telegram compared to WhatsApp. WhatsApp's got limitations on how many people can be on the group. Telegram hasn't got that group. So we've just all moved over now to Telegram. So there's a Telegram number, 084-962-2949. All you have to do is send the dealing desk your name, but also important is your equity account number. Okay, and then they'll send you a link back that you need to click on. And then you'll be able to have access to information, price sensitive information sometimes, and help you react in the market. But also to help you, I suggest is create a watch list of those potential winners, and as I say, use that PE ratio. And also what's important, there's one of those other little widgets, I think it's called security info, that you can also see the company's dividend yield. Anything more than 3%, which is average of the market, is good. Those are some of the things you can use in your decision making. But if you haven't got exposure to, if you don't want to have direct exposure to the share market, maybe consider having exposure to unit trust, and through that, having exposure to the equity market. And on our investment platform, we've got over 450 funds to choose from. And as I say, you haven't got exposure to a direct share market right now, maybe consider opening a share trading account with us. And you can click on those little links there that open up what we call a key information document. Gives you more explanation what the product's about, etc. So guys, from my side, the webinar recording as well as the PDF of this presentation hopefully will be sent out either by tomorrow or the latest by Friday. But from my side, happy investing and bye for now. If you've got any questions, you're welcome to drop us an email on wealth@psg.co.za. You can also get us on our OneStream line there, 0860-000-368. But from my side, thank you very much. And just here's my disclaimer. Everything I spoke about in this presentation is not for investment purposes. It's not for you. I didn't give you any investment advice. I want to highlight that for you. It's not investment advice. It's for education purposes only. So here's my disclaimer. Okay. Guys, from my side, thank you very much for being on this webinar. Until next month, all the best. Bye for now.